crucial Reserve Bank of India board meeting comes up on November 19th, where the government, through its board members, is expected to raise possibly 4 crucial issues, among other issues, of course. First, the Reserve Bank needs to bring down the minimum capital that banks need to maintain. 2, Reserve Bank needs to provide more liquidity in the market. 3, Reserve Bank needs to ease the filters which push a bank into prompt corrective action. And 4, Reserve Bank needs to provide special dispensation to small and medium enterprises, to SMEs. To discuss the pros and cons of some of these, I have with me Haseeb Drabu, economist, former banker and former State Finance Minister, Mr. B. Mahapatra, former Executive Director at the Reserve Bank of India, and Ashvin Parekh, the well-known banking expert. Before I go to my guests, let me just mention what we mean by minimum capital requirements or what is called the Basel requirements. Under the rules made by global banks at the Swiss city of Basel in the 90s, all banks have to keep minimum capital of 8%. Also, part of this 8%, that is 4.5%, has to be common equity, that is shareholders' equity. India, on its part, requires 5.5% as common equity and 9% as overall capital. Basel requires 8%. Now, India requires 1% more on all categories. The Reserve Bank's reasons for these over the years have been that, 1, in India, losses for banks are higher when loans go bad because the judicial system is very time-consuming, the time value of money erodes, and transaction costs like stamp duties are also high. These ensure that banks don't realize the true value of assets when they sell off a defaulter's collateral. The Reserve Bank also says that in most countries, the capital requirements are higher than Basel rules. For instance, in Mexico, in China, in South Africa, Turkey, in Singapore, the capital requirements are between 9 and 11%. So India is not alone in requiring more capital than Basel. Let me go to my guests on this issue. First up, Haseeb Drabu. What's your sense? Do you think Reserve Bank is becoming way too strict in capital requirements?
No, let's understand this in a certain context. That we're talking of 2 different things here. The reason why your regulatory capital requirements are higher than Basel and have been so is because the prudential norm system is not as robust as elsewhere. For instance, the basic issue of coverage ratio. The RBI has still not stipulated, at some point did stipulate, that you must have X amount of coverage ratio in a bank. You know, there are banks operating with 100% coverage ratios. We have banks operating with 30-35% coverage ratios. So there is a link between the regulatory part and the prudential part. I think we need to look at strengthening the prudential part before we strengthen or weaken or reduce the regulatory capital requirement. Second, we are operating in an economy which has a large informal segment, where credit flows are confidence-based, relationship-based, not credit history-based. You don't really have a credit history of accounts that you would have elsewhere. So the kind of lending that happens is in quote-unquote a certain intuitive relationship. It's not really. There are so many businesses where balance sheet lending doesn't happen. We're not only talking of the top 400, 500 corporates. You're talking of the SME segment, which don't have good, strong balance sheets, right? But they have good businesses.
Okay.
So when you look at the entire lending pattern, then you feel that to have a higher capital requirement by 1 percentage point, 100 basis points, I think is valid. Now, you may want to re-examine it, but while you do so, you need to understand, A, the stage that you are in, when a cleanup is happening, when a solvency code has come in, when NPA problem has surfaced because of lack of action for very many years. So that is how you would want to arrive at this, rather than just take a Basel versus India position.
Okay, fair point. Mr. Mahapatra, of course, you were present at the creation, as it were. You were in the Reserve Bank in the 90s and in the 2000s when it was implemented. So very quickly, has Mr. Drabu covered all the points, or do you think there are other reasons why Reserve Bank is keeping the 9%, or are you in the camp that 8% is fair?
Yeah, Mr. Drabu covered many points, but I just want to add some other dimension to the whole issue. First, this Basel norm of 8%, it came from the point of view of G10 countries initially.
Yes.
So from the point of view of advanced economies.
Yes.
So actually, they were the members of Basel Committee only till the global financial crisis of 2008.
Okay.
When it was expanded to G20, and India also became a member of the Basel Committee. Before that, it was a club of G10 only.
Yeah, but India accepted the Basel rules.
Yes. I mean, India and also many other countries.
Yes.
So the question is, this Basel 8% is really not a science. It is not like physics or chemistry, not like a natural science. It is a calibration.
Okay.
It is an average concept.
Okay. But are we over calibrating or calibrating to the higher end is the charge from the government?
Just listen.
Yes,
I'll just finish it. This is a calibration. This calibration was done based on the data supplied by these G10 countries.
Okay.
And as you know, in those G10 countries, the interest rates are low, the volatility of the rates are low, the recovery procedures are very fast, and the loss-driven default is low. So based on all these factors, this 8% was calibrated.
Derived. Okay.
And when the Basel II came, it applied external rating agencies rating to a loan.
Okay.
So based on that rating, the risk weights are calibrated.
Yes.
If it is AAA, maybe the risk weight will be 50%.
No.
If it is AA, maybe 75%.
Yes.
Or lower the rating, higher the risk weight.
Yes.
So these risk weights, again, calibration was done based on the risk weights or the ratings by Standard & Poor and Moody's.
Yes.
And Standard & Poor and Moody's have a long history of data. Whereas in our country, we depend on the rating of our domestic rating agencies, which do not have that long history.
Okay.
So the calibration could be different. Suppose the same loan exposure, which our domestic rating agencies have rated, if it is given to Standard & Poor or Moody's, the rating could be different.
Okay, fair point.
So based on that, ours is a very, the calibration is very close to the reality, and I think 9% is good enough, and it has stood the test of time for us.
Okay. Well, I'm trying to rush you so that I can get other points discussed as well. Mr. Parekh, what about this argument that, international banks which have international exposure need to follow international rules? Those banks which only serve domestic needs can be allowed to come to 8%. Will that work, or will there be a problem opening LCs?
No, I don't think that's a very valid argument. Let me articulate my thoughts. In addition to what Mr. Drabu and Mr. Mahapatra said, and I'm entirely endorsing the view that the regulator, if he has decided for this market that in comparison with Basel norms, 9% is a better norm, then the regulator is all the justification in doing so. Let me just add another dimension to what has already been said. One is, let's look at the leveraging of the balance sheet.
Okay.
Let's say, 8% you are leveraging 12.5 times. At 9% you are leveraging your balance sheet 11.1 times, which means you are exposing your deposit holders more to the risk, let's say, compared to what you would have done at 8%, for instance. So, that's the additional dimension that I would like to bring in. The regulator has to look at two things. He has to protect the deposit holders' interest, and he has to certainly look at the stability of the banking system. And I think from both those perspectives, 9% to my mind is actually, now with the NPA scenario and with the NCLT going so bad, in a sense so long, not even bad, I would certainly say that even 9% could have be reviewed to a higher percent,
Yeah, I think Reserve Bank was thinking of doing that, but they have just held out and not increased the capital lately. Otherwise, it was supposed to climb a little higher. But Mr. Mahapatra, finally, before we go to the next point, is there a case to keep a separate number for the banks that serve the domestic market? Keep that at 8%, but internationally facing banks at 9%?
I mean, if banks are like cooperative banks or regional rural banks, we might have a different standard because they are really not exposed to international markets.
Okay.
But other commercial banks, even if they are domestic oriented, their customers may be exporters or importers.
Okay.
So they have exposure to the outside world. And the LCs opened by them will not be accepted by external parties.
Okay.
So there, I mean, we stand to lose, I mean, business.
Okay.
I mean, our customers will suffer from that point of view.
Okay, okay. Well, there are a few more points that board members in the Reserve Bank have been making in the public domain. I have to take a break. I'll come back and ask you your reactions on those as well. We're back in a jiffy.